The market has been on an upward trajectory for several months. It seems to be in a kind of going into a holding pattern or a shifting. The dynamics seem to be shifting. Growth type stocks have mostly been in favor during this period of time, and it appears that that is shifting, at least as of Friday, is shifting into more defensive or value-oriented stocks. I will try to unpack this for you. Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is March 19, 2024. During the month of March, March has been a month where stocks have gone up and they've gone down. It's not a clear direction. You can pick, depends which day you pick. But the prior 4 months, November through February, especially the first 2 or 3, were very upward oriented. 2023 was value. Those in 2024 have been growth. Now, in the month of March, there seems to be the market is trying to find a direction. Is it going up or is it going to go back down? And if it goes up, is it going to favor the value stocks or the growth stocks? As of right now, it is shifting over to favoring value again from growth. Those would be more like Dow stocks. You could call them old economy stocks. I don't know the future. So as of today, growth is in favor. So I don't know, is it going to shift back the other way? But through last week, it clearly favored value type stocks and still moving in an upward direction. So I wanted to play, I have a couple of clips for you to play and that I think will help explain this and some perspectives. Now, the first one I'm going to play is Joe Terranova, who is well respected on Wall Street, and he seems to favor, he says money is coming out of growth stocks, particularly the Magnificent Seven, and going into value type stocks or defensive stocks. Some of those he considers winners, and he names some, for example, that are in the growth area that have become losers. And so he said, probably stay invested with winners, and the ones he names are value oriented. Some of the big names that have been growth stocks he names are down quite a bit. So take a listen to Joe Terranova.
It does take us to our talk of the tape, the return of volatility, and if investors need to prepare for a pickup in that, especially with another Fed meeting looming next week. Let's ask Joe Terranova of Reppond Investment Partners. He's a CNBC contributor. He's with us here at Post 9. Is that your expectation? I mean, is that where we're trending? It's about to get interesting for a little bit?
I think the market's about to get very moody, and that's a dangerous place for investors. Since November, the market has been trading off of a sunny disposition, the personality of the market. Now you get into this environment where it's about the mood. Everyone wants to be a Monday morning armchair economist, which is probably the most dangerous and worst thing you could be doing right now.
Think of nothing more exciting than doing that.
Yeah, exactly. And I think everyone within the market, they're looking at all the losers year to date and saying, okay, is it time to pivot in that direction? And I think you've got the playbook so far year to date. The playbook seems to be stick with the winners, stick with the quality, go through the names today that are down so significantly. You've got Snap down 4%. It's down 32% year to date. Tesla, of all the Mag 7s, down the most, down 4%, down 35% year to date. You could go through them all. Chewy down 4%. ARK, unfortunately, is down 3% once again today. That's down 6% on the year. So if you're looking to do something in the market today, if you feel the need that you have to do something, look at commodities. Copper's up 5% month to date. Oil's got the breakout above $80, trading 81. We haven't seen that price since early November. XLE at a level we haven't seen since the end of October. You want to maintain exposure to energy at equal weight or higher.
I heard earlier today, though, no, now's the time to go to the Russell. Go to
Absolutely
places.
not.
Why not?
Absolutely not.
Why not?
Because the long duration trade is under duress again. All you have to do is look at the KRE. KRE is down 9% year to date. down 2.5% plus so far today. Long duration under stress. Look at the Russell 2000 index. How much of that index can be defined as quality? Very narrow subset of it. That narrow subset, okay, you could find opportunity there. But if the Federal Reserve is sitting back and waiting, then you as an investor want to do the same thing with those long duration assets.
All right, I mean, looking at the Russell today's down 2%. It's down almost 2.5% on the week. Now, several of the mega caps are up this week. To your point,
quality.
So is the death of the quality and or mega cap trade greatly exaggerated? Because that's sort of where the narrative's trying to go, that NVIDIA is a sign that the momentum large cap trade is tired and it may be sleeping for a while.
So if NVIDIA is going to move lower, the market is going to move in that direction as well, just because the halo from NVIDIA touches so many places in AI software and in the semiconductors.
Yeah, but Apple's up today, Microsoft is up today, Alphabet's up today, Amazon's up today.
Okay.
What do you mean? Those are large stocks.
And that's why the market is down marginally, 50 basis points. That's why we don't have a larger decline, 1 to 2%, which has been missing from the market for many months, like we're seeing in the Russell, because you've got the push-pull, okay? You've got the push-pull of Apple, Alphabet, which had been weak, seeing a little bit of buying activity as a rotation away from NVIDIA and some of the AI halo names is unfolding.
But that's a good thing, though.
Good thing,
isn't it?
Absolutely.
So why is the market going to be so, as you say, moody, as long as you have what just looks like to be a bit of a rotation?
Because I think it's been since November a pretty well-defined, nice walk up the stairs higher and higher. And I think you're at a moment right now where you're really void of any catalyst for the market. Maybe Chairman Powell and the Federal Reserve gives us that next week in a place I don't think investors are looking, which is the balance sheet. We'll talk about that in a little bit. The balance sheet is going to be very interesting, but you're going to get earnings in April, and I just don't think the degree and magnitude of the advance over the last several months can be continued. Expect, in my opinion, choppy trade.
Next, another person, Ed Yardeni, who, again, well-respected, many decades on Wall Street. He says kind of the same thing in his own words, that money is coming out of the Magnificent Seven or the Fabulous Four, or whatever you want to call it, and is moving into defensive sectors. The defensive sectors would be things like energy, utilities, staples, and healthcare. And the market is overbought, especially when you look at the Magnificent Seven, and he believes that has got to pull back a ways. And as it does, he sees the money going into the defensive sectors. But neither one of them, Joe Terranova or Ed Yardeni, are saying that the market is going to come down per se. It's more that it is shifting. So again, here's his perspective. Take a listen.
As you see the makeup of this market change a bit, right? NVIDIA cool down and some of these other areas pick up. What are you thinking?
I'm thinking this is a healthy development, quite honestly. We've seen a lot of focus on the outperformance of the Magnificent Seven. And as we know, some of the Magnificent Seven haven't been so magnificent recently. And if some money comes out of the Magnificent Seven and spread more evenly across the rest of the market, that would be a healthy thing. For example, the S&P equal weighted index has recently gone to a new high, which is a good thing. So I think that a broadening of the market is probably what's in store. And I think we're also likely to see less momentum. I just looked at the latest Investors Intelligence bull-bear ratio, and it's off the charts. It's not completely off the charts, but it's up to 4.2. It can go higher. It has gone higher in the past, but this is up from 0.56 right at the bottom of the of the bull market, right when the bull market just started. The sentiment was horrible. Now everybody's bullish, and that means there may not be enough bears around to convert into bulls to keep the momentum going. So I think we're going to see some weakness in the momentum trade and more of a spreading of the market to other sectors and industries.
Now I'm going to make a shift, get away from the market per se, and talk a little bit more about economics. Sarah Eisen is interviewing Ken Griffin, and she is asking the question about the interest rate cuts. Are we going to have increases in interest rates from the Fed, or decreases, or a pause? And where is the economy, which would dictate one way or the other? This will explain, and he's the CEO of the Citadel, which is a gigantic hedge fund, and well respected. And these are his views on inflation and interest rate cuts, because interest rates cuts are going to follow the direction of inflation. So whether we have them or not. He believes that the Fed is likely to pause right here and not raise them or lower them, and maybe for a longer period than we suspect, because if they lower them, he believes if they lower them and then inflation kicks up, then they have to raise interest rates. He sees that would be definitely problematic. So their inclination, he believes, is to sit and kind of hold back and see what direction inflation actually goes. But a good perspective, and from a successful and well-respected economist and hedge fund manager. So take a listen to Ken Griffin and Sarah Eisen.
Let's start with the news, Ken. And we'll talk about Miami later on. But just on the news and on the markets, we got an inflation report this morning that was hotter than expected. Again, the markets don't seem that concerned about it, shrugging it off. What is your view right now on the inflation threat that we're facing?
Look, the inflation number this morning was actually pretty close to consensus. I would say it was either hot or lukewarm. It was pretty close to consensus. Big picture, we still have an enormous amount of government spending, and that's pro-inflationary. And we are also going through a period of history with deglobalization. That's pro-inflationary. So we've got two big tailwinds that continue to support the inflation narrative. Now, the good news is that the Fed's tighter monetary policy is clearly bringing inflation rates down, but it is a bit of a battle between two different opposing forces: the monetary policy of the Fed, and the profligate fiscal spending of Washington, and the push in the West towards deglobalization.
So should the Fed be cutting rates?
At this point in time, look, I think they've been pretty clear. They're going to continue to wait to see how the data plays out. And if I'm them, I don't want to cut too quickly. The worst thing they could end up doing is cutting, pausing, and then changing direction back towards higher rates quickly. That would, in my opinion, be the most devastating course of action they could pursue. So I think they're going to be a bit slower than people were expecting, let's call it 2 months ago, in cutting rates. And I think we're seeing that play out.
Market's expecting now 3 or 4, as much as 4 rate cuts this year. Do you think the market's a little overexcited about it?
I think the market is looking at some of the increases in unemployment. There's a little sign of softening in the labor markets. And I think the market's very focused on the belief that the Fed's going to try to prevent us from heading into a higher unemployment regime. So that would be the case for more cuts than the inflation hawks might be hoping for, which is I would rather see the inflation genie put back in the bottle and resoundingly put back in the bottle before the Fed starts to cut too fast.
Now I want to end with a piece from about Felix Zoff. Felix Zoff is a money manager, many decades in Europe. He's out of Switzerland, but he is immensely successful and has been effective in calling the direction of the market. And when I say that, I mean more from a macro perspective. In other words, are we in a paradigm of the market generally going up? Are we in a paradigm of the market generally going down or even collapsing? His success, which relates to the huge amount of money that he manages, is that he has been successful in calling both of those directions for many decades. And so a lot of people follow him because I don't know what his methodology is. I happen to think it is not intuition. I think he's not just a hunch that I think the market's going down. I think he has a lot of mathematics and analysis behind it. But so this came from, so this is secondhand. So I'm going to explain it and disclose it to you. I take a blog from Steve Blumenthal called On My Radar. And Steve writes a very good, I know who Steve Blumenthal is, and he has a relationship with Felix Zoff. So he writes his piece, and sometimes he's stating things in the first-hand tense. And so he wrote this. I'm going to quote him from his blog this last Friday, March the 15th. In his, the client call that Zuloff did that Steve Blumenthal was part of. So I'm sorry for the secondhand nature of this, but it's very insightful. And I can't emphasize enough, and if you know who Felix Zuloff is, you will probably agree with me, that his insights are incredibly helpful, and he doesn't speak a lot to outside people. And whenever you can glean some thinking from Felix Zuloff, it's usually pretty good. So I'm going to read you what, this is a few sentences from what Blumenthal wrote about him. He said the following, in quote, "I just finished listening to Felix Zuloff's quarterly client call. He believes the market is peaking here. He believes the market is peaking here. And his base case, average case, is for a 20% correction, a decline of 20% in the market. I think of a correction more like 10 to 15%. So 20% is a very strong correction, but it's not a crash. It's not a collapse. A 20% correction, followed by more juice from the Fed and a rally to potentially higher highs. And this is called, in the cycle of investing, called the euphoric phase, when people get so enthusiastic and drive the market to heights that it has not been. A good example would be the 1999. He still predicts, as he has in the past, he still predicts that we'll see what he calls a granddaddy bear. Now, so I don't want to separate these two. A 20% correction, which is, he believes, right in front of us, I'll say 2024. A euphoric phase, which will push the market to higher highs, and then a granddaddy bear market, sometime in the latter half of the decade. So I will say my interpretation is 2025 to 2030. That would be defined as the latter half. Blumenthal says this, granddaddy in Felix speak, and he's friends with Felix, so I think he knows what he means. Granddaddy in Felix speak means an 80% collapse, about an 80% collapse. My view, Blumenthal writes, isn't that extreme. But who knows? It's tough to bet against Felix. Well said, and that's the reason I'm quoting it, because this is a very good piece spoken from a client presentation, a client call that Zuloff did. He wrote this on Friday, so I'm assuming this probably happened in the previous week. And so when you think of these two things, this is about managing money. You managing or someone managing your money, me as a money manager, managing client money with a mathematical approach, and thinking in terms of what's in front of us is likely, if Zuloff is right, a 20% decline, which will scare a lot of people, and then a rally, which again, I call that a head fake, getting people to buy back in, followed in the coming years, 2, 3, 4, 5 years out into the future, we don't know. I'll say 3 to 4 to pick an average number, but I don't know. An 80% collapse. That puts it somewhere between 2008 and 1929. That would not just scare a lot of people, it would wipe a lot of people out. It would wipe most people out. So I'm saying this to you to think about the methodology that you use, that you are prepared mentally and emotionally for some time in our future, let's say part of this decade, where there is a collapse. If this was coming from someone besides Felix Zoff, you could say whatever. But when you look at his track record, it's hard to dismiss, as Steve Blumenthal points out. So I say that as an FYI. I don't like the looks of this, Marv, being surrounded by bears. Sometimes people are feeling that bears are everywhere, and I don't know for sure. I just quoted you some information from Felix Zoff and his view. I don't know. I mean, I can't tell you that that's the case because the market continues. Last year and this year has so far fooled a lot of people who think in terms of, I think this, I think that. People who are speculating on the direction of the market because of their intuition or whatever they're reading. Many of them have been wrong. So be careful. Maybe there are bears around us, but maybe not. You've got to think about how you navigate from here, especially the positive side of the market as well as the downside of the market. Thank you for watching. If you have questions or comments, leave them in the comment section below.